All right, guys, we'll go ahead and get started. Houzd Mortgage is here. They're going to tell us exactly what you need to know for an entire year on how to make millions of dollars. So if you leave here and you don't make $1 million, Sarah has guaranteed me that she'll pay whatever you don't make. So
I don't remember that conversation.
Keep your receipts. You'll just take it now and go on vacation? Yeah, that would be easier, wouldn't it? All right, so we got Jose and Sarah. They're awesome. Sarah is one of my main loan officers. She takes care of me on so many crazy things and so many crazy deals. So if you ever have any clients that just can't quite get it done with someone else, call Sarah. And if you've got clients that are really easy, call Sarah. She'll take care of them too. So turn it over to you, Jose. There's your mic.
And then Jose is also a loan officer in our branch, and he speaks Spanish.
That's correct.
He helps so many of our clients.
So it's Jose, not Houzd.
Correct.
Correct.
Yep.
Thank you for asking.
Exactly.
Okay. Well, we are so excited to share this with you. So essentially, a lot of this data comes from a program called MBS Highway, and they give a lot of people in the mortgage industry tools to kind of estimate what rates are going to do, kind of figure out the ideal time to lock their clients in for their interest rate to hopefully get them better terms on their mortgage. And they came out with a 2023 rate and housing forecast. And Jose has been kind enough, his rebranding skills are out of this world. He has, edited this a little bit to make it a little bit more digestible. And we would love to just give you, some of the facts that they're looking at to see what rates could potentially do in 2023. Now, rates are so sensitive. They get offended by everything. So none of this is guaranteed, but it really is just data driven as to, all right, this is the data that we've seen last year. This is kind of where the economy's headed. And this is what it looks like we should see in 2023.
I had one officer the other day tell me, he said, y'all know what rates are doing, just watch gas prices. When the gas prices come down, rates come down. When they go up, they go up. And I've never thought of that.
Yeah.
I've never heard of that before.
Yeah. Well, and
it's how true it is, but
yeah, and
it has a big portion. Yeah,
it does, and you'll see that in some of these with like how we're measuring inflation. Rates follow inflation. So when you see gas prices higher, it's showing inflation is a little higher. When gas prices are lower, the inflation's a little lower. So it is a good indicator because of that relationship with inflation and interest rates.
Mm-hmm. So kind of like what Sarah was saying, MBS Highway is this analyst group that, the mortgage world is very acquainted with. It lives on a lot of people's screens. We, watch what the yields are doing, the bond market, that kind of stuff through them. And they're really good at predicting stuff just because they've been doing this forever. So this is data that they had provided. We have digested it and then try to simplify it a little bit and expand on it a little bit. So it makes a little bit more sense. So anyways, we'll just kind of dive into it. What we've seen, we've seen prices come down lately, following record highs over the past few years. So let's see what 2023 has in store for us.
I understand now the rates are lower than they've been in 4 months.
Yeah, so we've had a couple of drops, and that's due to inflation dropping. And so we'll look at some charts that show why that is and how that correlates. But yeah, basically, rates started slowly rising, to kick off 2022. Up until that point, everything kind of had been, pretty low, as you've probably seen in the threes. And then going into winter, we saw demand decrease as rates, went up. So demand is driven by supply and demand, and rates have a big impact on that. So we're going to take a look at how the stuff that started last year and started putting, its tracks in the way might impact this year. We saw some improvements at the end of the year, and we hope that those improvements will also continue on through 2023. So let's jump into that.
Okay, so this is exactly what you're talking about with gas prices. So inflation drives mortgage rates. There's a very close relationship, and we can send you guys a copy of these slides too.
Thank you.
Because we want to arm you with this information when your clients are like, well, why do you think you're saying and it's all data driven, right? So inflation drives mortgage rates. In this chart, when you're looking at it, you can see, so the pink or orange line is the consumer the core consumer price index. Now that's a measurement of inflation. We like the core consumer price index as that measurement because it gives data sooner. So it's a little better for forecasting. And so using that measurement, we're looking at inflation. So in this chart, you can see the close relationship starting in January 2018. Then you see coming around, after January of 2020, you see this QE period, right? That QE period was quantitative easing. That's when the Fed was buying mortgage bonds and mortgage-backed securities to keep rates right around 3%. So even though you see, inflation start to come up, you see those rates are staying right around that 3% mark because the Fed was practicing quantitative easing and they were trying to buy those securities and those bonds to keep rates lower, even though inflation was coming up higher. Does that make sense? Okay. Then the Fed started to realize January 2022, this is having a big impact on inflation. It's getting out of control. The only way we're going to be able to combat inflation is to increase interest rates. So we are going to slow down, ultimately stop our quantitative easing to have this relationship resume.
You talk about the Fed buying these rates and stuff.
Mm-hmm.
What money are they using to buy it with? Is that
printed?
That's my feeling, but at the same time, I'm thinking, okay, they're buying this, but that's raising our debt limit as
Right.
well, which is going that's going the wrong way, in my opinion.
Well, that's why inflation rose so much, because basically there's a bunch of new money, so the old money lost value, right? So it was pumped in with new money that deflated the value of everything else. So yeah, you're right in that aspect. It is wrong, and that's why we see, if we look at this chart, when inflation started to rise, rates stayed the same. That's not how things work. They should have gone up. The reason they didn't is because it was being stimulated by the Fed with the funds that they were pulling into the market. Where they stopped here in the end of this QE period in the black, you see that there's no longer this new money coming in to stimulate that. So what happens? It starts to go up. And I'll go back to Sarah on that. That's where you were at.
Right. And some of the Fed, with some of their investments, they have like a runoff with their investments, and they were essentially taking some of that runoff and using that to buy the bonds. So not all of it was just printed money. Some of it was money that they had, that they were using the investments that they had in the market and using that to purchase those bonds. Right. But when you're looking at this, you also see at the end of 2022, those rates are starting to come down and that inflation is starting to come down. And you see that relationship, continue to resume. So this is really just to show you guys the relationship with typically that we see with inflation and with mortgage rates.
Mm-hmm.
Is there a website that we can go to see this happen before?
So, if you just look up in this scenario, what we're seeing here, there's just two different things, right? You have the 30-year fixed rates. You can just Google 30-year fixed rate mortgage, or mortgage rates, and you'll have a chart of that. But the real indicator is the CPI, the Consumer Price Index. So if you watch that, basically, if that goes up, that means inflation is going up, rates will also go up. There's another chart, and we'll get into that here in just a moment, that is also a great indicator to watch to see what rates will happen. So there's a couple different things that everyone watches that will kind of tell us, hey, this is what is tending or trending to happen.
It may not be in the form of the chart. It may just be looking up, all right, what's the core consumer price index? Where are interest rates? And you can kind of see how that's coming together. We love MBS Highway. We get spoiled a little bit because they'll publish stuff like this for us that we just are like, oh, what is MBS Highway showing in this chart? So if you guys are MBS. Yep.
Yeah, mortgage-backed securities highway. Yeah.
Yep.
Do you follow CoreLogic by any chance? They do a lot of real estate and mortgage data. Do you look at them?
Yeah, we do, and that is a big one that MBS Highway uses too for their data.
I was going to say, how do they compare in terms?
Yeah, they're usually
predictions?
looking at CoreLogic and comparing it with other predictions and kind of measuring the validity and kind of what their CoreLogic is using.
Mm-hmm. So if we go into this next slide here, here we're talking about inflation and peaking. So When measuring inflation, we look at that, the core consumer price index, so that CPI, but the core aspect of it. The ending in 2022, the core, which takes out food, energy, was at 5.7% year-over-year basis. So if you look at this, you can see that inflation over here is starting to shrink. This is, the past couple of years that you see here. This is where we're currently at. So we're on a downward trajectory. And then as we are entering the new year here, we're over here in this white one right here. That's January of last year. So the new one, when we get the readings for January, would come over here, right? So you would see, okay, year over year, it came down by this much. So basically, you'll see that, as these start to replace, we're coming down as far as inflation goes compared to the year prior.
So how that core consumer price index is calculated, it's taking the last 12 months and each year what inflation was at those months. So that 5.7% is the average of the last 12 months. So what Jose is saying is that our inflation numbers are much lower than what they were 12 months ago, correct? So as we start moving into this new year, January was at 6%. As we're moving into this new year, we're going to start seeing some of these lower numbers replace some of those higher, and that's going to show inflation coming down more quickly. Does that make sense?
It looks like it's going up in December.
Yeah, just a little bit, but it's much better than where we were at, looking at last December, last January.
Well, and if you look at it, it's down 1/3% to a year before. That's what this is showing right here. That 0.3. So 1 year before that, it was 1/3 higher.
What was it the year before that? So you see it's coming down. Where was it?
Yeah.
If we look at December,
January of 21.
This one only goes till June of 21, but if you look at June of 21, it was at 0.8%.
well, it came down by
Compared to
0.8.
2 years ago, we're still not in very good shape in terms of inflation.
No, we're coming down on that aspect of it. If we go back to this chart here, just for example, if we go back here, if we look at this reading, here's where inflation, we're currently here. Compared to 2 years ago, you're right.
Yeah.
We're down here. But we have been peaked up at these levels and we're starting to come down here. And then we're even lower than this right now. We're probably down over here. So 5.7 would be right around here. So as it continues through the year and these reports start to catch up, you'll see that come down as well.
Okay, so this kind of can show you further back is kind of where that was at. That's a great question.
So there's, like December when people are out buying Christmas presents, does that affect that at all? It seems like.
Well, it'd be weighing December up against December. So it'd be, similar patterns. Yeah. So let's see, where were we at? We were.
I think here.
Yeah.
So kind of moving on to the next slide. So of that CPI, that consumer price index, shelter costs make up 39% of that calculation. So when you're looking at shelter costs, this is the apartment list rent year over year. So you can see that the apartment list rent came up and then it's actually started to come down a little bit. But how that's going to be measured with the CPI, because when people are renting apartments, they have to finish their lease, right? It doesn't just all of a sudden, oh, they've changed the list and like how much we can rent this for, so now we can change our lease. No, you finish out your lease, and then once that lease is finished out, you would negotiate a new lease. Right, there's a lag. So with this is in real time, the actual numbers that we're seeing. We're starting to see them come down. But with the CPI, how it's measured, it's actually measuring it with the lag. So on the CPI, it's still showing that the costs are going up because of that lag. It hasn't quite shown, in real time what we're seeing, that they've started to come down. Does that make sense?
Because it's a 12-month average, right? So even though, at one point of the year, it was that high, right now we're this low. When you average it out, it's coming, more steady like this. So that's what the CPI shows. So that's really, where it's at. Because it's not because it was at the top, it's always there. You take the low point and the high point, and the middle is what you're seeing there on that CPI.
Does that make sense?
So the peak one, it says apartment list rent, year over year went up that high.
Right.
Yeah.
Almost 17%.
18%, yeah.
Right.
And right now we're, about 4%, and that's year over year, right?
Is this nationwide?
Yeah.
This is all nationwide. So, and then how that CPI measures it, it just has a lag effect. And so with it, you can see, and this next one kind of shows it a little better, but you can kind of see that if you're looking at it as a roller coaster, what's actually happening in real time is we're at the end of that roller coaster. That's the real shelter costs. How it's measured with the CPI, it's showing that we're at the back end. It hasn't shown that we've kind of fully peaked to it yet. What the reports are saying is that come January, it's gonna essentially kind of level out to where it actually is at that peak, and we should start to see it come down on the CPI numbers following January. Does that make sense?
Since CPI is measuring inflation, as that comes down, rates also are projected to come down. So that's one factor there, leading to the stuff we'll talk about today, as to why it's projected that rates would come down. So one factor, inflation coming down. So we're really here. But yeah, we'll see those measurements for the next little bit, and then once that curve's over, it'll come down and down as far as inflation goes on that end. So, as Sarah mentioned, shelter is 39% of the core CPI. Prices have come down on food, gas, clothing, etc. All those are reflected in CPI, but shelter costs, although it is decelerating, it's still showing an increase in
I
CPI.
thought, food doesn't include energy doesn't include in the CPI.
It's
And I'm sure not seeing food prices coming down. I'm questioning the data right now.
Yeah. I think this is basically just saying that prices across the board, I mean, you've seen it in gas, you've seen it in some other factors. Some are slower to come down as much as others. Gas is a more dramatic.
and it
right?
depends.
We've
It's
really seen that come
that's
down
also regional too. Like this is talking about the country in general.
as a whole.
So we might see something here completely different. I mean, California, their gas prices are still high. Right, I was just there for the last month. So their regional readings would look different. But yeah, as a country, those things are starting to come down.
Maybe not as fast as we would like,
Yeah.
but they are starting to come down a little bit.
So
this is just another relationship. So this is showing you basically the 30-year mortgage rates versus the 10-year treasury spread. So with this, there's also just like there's a close relationship with inflation, mortgage rates also have a very close relationship with the 10-year treasury. And so this is essentially showing you, I'm just going to come on this side. So when you're looking at this chart, you can see that the 10-year treasury is that white line, and you see that the yellow line is the 30-year fixed mortgage rate. Usually a normal spread is 175 to 200 basis points. That's typically,
which
let's
is
just say for this,
1.75% to 2%.
right.
is-
So typically if you see the 10-year treasury, you add 1.75 to 2% to what the 10-year treasury is reporting, and that gives you where the interest rate is reporting. This has been the case for the last 35 years, okay, that there's been this 1.75 to 2% spread between the two. But what happened in 2022 is that you see the spread jumped to 300 basis points, or the rates became 3% higher than what the 10-year treasury was reporting. Now, why that is because the smart money in the market was essentially looking at servicing value. So with any mortgage on the back end, once it's sold to the secondary market, there's something called servicing value. It's the value that the servicer holds in collecting the payments for the mortgage and answering clients' questions. It's essentially what value they have in collecting those. Get to your
It's kind of funny to see the 11% up there.
right when you look.
Back in 90, so probably was 97, 99 era, I was buying properties with no money down.
Right.
And asking the seller to carry back a second
Yeah.
for 10 and 11%.
Yeah.
Because it made sense. I didn't have to go borrow money. He was carrying the money.
Mhm.
But he
Right.
wanted to do it for a price. And I'm
Right.
saying, hey, I'll offer you 10, 11%. He's like, really? You do that? You know?
Yeah.
And it made sense at the time. But
Right.
now to look at it and say, holy crap, we're paying 11% interest in some of these deals.
Right.
My house is at 8% when I bought it.
Right.
You know, and I think now you guys are screaming and crying at 6%.
Yeah. Well, and
What was the price of your home?
Right.
it's true.
That's a big difference.
No question.
Right. And so I think because of where home values are and some other factors, the problem that you saw and why that jumped is because you started to lose the servicing value of the mortgage. They were thinking, all right, someone's not going to hold on, for instance, a servicing value. So if someone has a 5% interest rate, it has a higher servicing value than someone that has a mortgage with a 7% rate, right? Because the chances are they're going to hold on to it longer. So there's more value in the person collecting those payments.
Yeah, if I was a servicer, right, I wouldn't buy, if say I had, 10 5%ers and 5 5%er, I would buy the one that had the lowest one because it's likely that I'll be able to service them for longer. If I'm buying the other ones, then, maybe they'll refinance in 6 months. Now I got to go get new clientele. That just becomes expensive because I got to pay for those rights to service them. And then the churn is super fast. So when that happens, which is what we're seeing here, the values come down because no one wants to buy and just keep churning and churning because those rights are, really minimal at that point.
We also saw investors cap interest rates. So like on our end, especially for investment properties, secondary homes, they would cap it at 7.125, but there'd be a charge with that interest rate instead of just having the interest rate increase, right? So instead of saying, all right, this is where it's pricing out at, with some rates, they were capping them because they didn't want to lose more servicing value. Does that make sense? So with it, you see this spread that it jumped with the 300 basis points or a 3% change, which is different than in the past 35 years with what we've seen. Essentially, the thought is, as we see inflation start to come down and as interest rates start to come down, we're going to see that servicing value get added back in to the mortgage and the interest rates, and that's going to help it come back to a normal spread. So it'll help those interest rates come down even faster because there's going to be more servicing value, which is what made rates, part of why they jumped up so much is because we were losing that value and the spread became bigger.
Yeah, I never realized that at the time, because I was in the pot getting cooked, just like everybody else. Well, I didn't realize they lowered the rates down into the 2 and 3s. Looks like on here.
Yeah.
Back in the 08, 09 when they're trying to get everything to come back.
Right.
I didn't realize they were that low then, but it's interesting.
Well, and typically when we're in a recession, the Fed is trying to get more activity in the market. And so they're lowering interest rates to try to get people to come back and start doing things in the market.
Yeah, you asked earlier what's like a good thing to look at. This is what most
Another
people
one.
look at is, hey, what's the 10-year treasury doing? Okay, if I understand where that spread's at, then I can say, okay, if the the 10-year is at 3%, then rates will probably be, if right now the spread is at 300, okay, then it's gonna be about 6%ish, right, in that range. If it's down to 200 basis points, then that spread would be, like I said, 2%. So you're in the 5s at that point. So, but yeah, as to what Sarah was saying there, we're starting to see that shrink. And as that happens, basically bonds are going to become more attractive again. When it becomes more attractive, they'll buy some more bonds, which causes the demand to go up on the bonds, which makes the yield go down on them. When yields go down, right, as we're seeing here, that means rates also go down. So
I'm kind of curious, and just in this room, what's the highest interest rate people remember?
17.
And mortgage rates are just rates?
Yeah, mortgage rates.
14.
Jimmy Carter.
Back in the
You were
80s.
born yet.
I don't think we were burned yet.
nope.
Yeah, my dad bought his farm at 20% interest.
Big renting for online.
Yeah.
My first home was a negative amortization,
Oh, yeah?
Really?
late 70s.
That's interesting.
New build.
So yeah, that's what we're seeing here. So if we go to the next slide here, there we go. Closing out 2022, the spread started to narrow. So from 300 basis points, it was dropping to about 260, 270. So 2.6 to 2.7%, right, on that spread. So we're already seeing that shrink. We think that the Treasury rate continues to go down towards 3% or less from inflation, right, decreasing. What that means then, it means that rates would follow. So if that happens, servicing values will come back up, the spreads will shrink down towards 3%, from 3 to 2%. And if that happens and bonds go down, then you're projected to be right around those 5s. So if this comes down back to what it's normally at, right, with that 2% spread, and the yields come down to about 3%, the projection is in the first part of the year that you're coming down into the 5s as far as rates go. So, did you have anything else on that?
Do you have any questions on?
You're
Anything
saying
so far?
the first part of this year?
That's the
It's the
projection.
first part of
gonna-
the year because it's the first part of the year.
We're
Yeah.
gonna get to that. We will get to that. I think, to be honest with you, some of these charts make me a little sad because they are things that we see with our clients, and we want our clients to make healthy, good financial decisions so that they're continuing to build wealth. Now, these charts show that it does look like a recession is coming, and these are just some of the signs of a recession coming. So with this first chart, I don't know why I feel like I need to stand up and come on the other side every time.
Because of the glare.
I know. Well, and I want to be close to it. So when we're looking at this, in January of 2018, this is showing you how many billions of US dollars, this top chart, was on credit card and other revolving debt. Okay. So you see that start to come up. Then in, around January of 2020, when we started to get those stimulus checks, that started to come down. People consolidated their debt because they had so much equity into their home. So we started to see revolving debt come down. Now, over time, with inflation, with other factors, we've seen that credit card and other revolving debt continue to climb. So with that, unfortunately, that does hit a wall. At a certain point, you can only max out your card for so long. And so with that, this is showing you how many more billions of US dollars we've seen come on credit card and other revolving debt. So you see now it's much higher than it was even before or kind of during that COVID when they were giving those stimulus checks.
I remember talking to a friend at one time that was hanging on with his fingernails to his home equity line of credit.
Yeah.
And then the bank says, we're done. We're shutting off your line of credit.
Yeah.
And overnight, that portion of his life saving, buoy, so to speak, was gone.
Right.
And that same thing could happen.
Yeah. And so I think the scary thing is seeing just how that number has climbed. This other one shows the personal savings rate. So those three hikes, those were those 3 stimulus checks. So when you're looking at each of these hikes, that was a stimulus check, that was a stimulus check, that was a stimulus check. So you saw that people were saving more once they had those stimulus checks. But you see now where people's savings are at, for the majority, they're below even where they were before January of 2022, as it was reported in September 22. So, again, you see that is going to hit a wall. And unfortunately, that's an indication that a recession is coming, that people are not going to be able to afford what they currently have.
And recession sounds scary, but reality means, hey, people are going to be more careful when it comes to buying and spending money. That's not a bad thing, to be careful with your spend.
Yeah, and people are essentially not changing their lifestyle, even though things have cost more. That's one of the biggest things, is they're kind of keeping the same lifestyle, but they're just using it with depleted savings and more debt in order to maintain that lifestyle.
So you can assume there's going to be less demand for housing.
Well,
Ease up prices a little more.
Well, that's what we're seeing right now. We're seeing prices ease. And we'll get to, the hard part is it's all based on demand, right?
Mm-hmm.
And that's one of the following slides here where we talk about, the current supply of the housing. So we can talk a little bit more on that then. But yeah.
I thought it was kind of interesting a couple of years ago when we started seeing Vineyard and all these apartment complexes exploding up and thinking, how are they gonna fill these things? There's not that many people.
Well, look at the.
And there were that many people.
Yeah.
I didn't see it as an agent.
Yeah.
I
Right.
thought, these guys are crazy. That's why I look at the same thing with commercial right now. How many commercial buildings are they putting up everywhere? And they're empty.
Well, and here's the thing too, to call out, and we'll talk about this on the next slide as well, but, I mean, obviously there's clear signs of recession and that stuff. The reason you don't hear that much about it like nationally, right, is because the National Bureau of Economic Research has to go ahead and do it, and they normally don't disclose that till you've been in a year of it. So maybe by the time you hear it, you're already exiting or in the recession, right? So basically they have to measure it for a full year before, they really bring anything up on that end of it. So, but yeah, if we look at the signs, their signs are clear, there is recession. And we'll talk about, another indicator here as to, a clear recession.
I just see my own family with my own children, and I mean, I've never seen anything like the travel that people are doing right now. And I mean, we've heard for a while we're in a recession, or during the COVID, we need to, be careful. But I
It's like my vacation.
don't see anybody,
Anybody pulling back or
at all.
changing.
From my viewpoint, I don't see anybody pulling back, and I don't see the house prices going down either that everybody keeps telling us.
Yeah, well, it's interesting. To your point, I mean, everyone got used to having such cheap debt for so long, for a couple of years, right? So when that happens, you can afford a little bit more, or you can spend a little bit more because it doesn't cost you as much. So we got into those habits. Harshly, those have to at some point stop, and that's kind of where we're headed on that end of it. As far as like home prices and stuff, yeah, when you look at it on a national level, it's come down, but they're still appreciating, just not as fast. So there is still appreciation happening, just not at the crazy rates we've been seeing over the last 2 years. And part of the reason why those rates were so crazy is because everybody could afford more. So you could pay $400,000 for a $350,000 home, right? And as long as it appraised, then okay, you got it done.
And sometimes recession, I think when we hear that, it's like a very scary word. It's like, well, what's going to happen if we're in a recession? But I do think it's important to note, typically in a recession, interest rates come down. Interest rates have a pretty correlated, effect with supply and demand. And so sometimes, things pick up in a recession because you have lower interest rates. They're trying to get people back into the market because the economy has slowed. And so with that, they're trying to make things cheaper. So I think that it's a sign that there may need to be some relief, sooner than later.
I mean, a very real example of that was COVID, right? Everything halted, okay? Dropped rates on everything so that everyone could still consume. And, unfortunately, it was held for too long that way. So we got into this cycle. But yeah, that's basically what happens, right? As Sarah said, in recession, you still need economic activity to happen. So the way to make that happen is make it cheaper to make those things happen.
Remind me, what was COVID?
I don't know. I think it's like this flu that we had.
Anything on there, didn't it?
I feel so bad. Jeff, I told him it's like a 20-minute presentation and we're at 35 minutes. So we'll try
You
to,
guys want him to quit?
I don't mean to because we're like, this is taking way longer. This is another indication of a recession. So essentially you have the 10-year treasury yield. When you take it and you minus the 3-month, it should always be a positive number, right? But when you see the
Well, explain what that means, I guess. Basically, normally, when you lock up your money for longer, you'd expect to get paid more because you're locking up your money for longer. Right now, what Sarah's explaining is, that's not the case. So the 3-month has a higher return than the 10-year, which is not how it's supposed to be. But
right. So essentially, what happens then, because you'd be more profitable with a 3-month than a 10-year, when you subtract what the 10-year is doing in a 3-month, you get a negative number, and that's when the yield curve becomes inverted. So with this, another indication that a recession is coming. All of those highlighted areas, those are a recession. And then
10 years.
right, and then each of those, you see the zero line, each of those dips was when it became negative, it inverted. And then you see shortly following a recession followed. Does that make sense? So you see it kind of go into the negative shortly after recession, negative shortly after recession. Each of those, the only time it's gone below, you usually do see recession. 2020, that, in the COVID recession, you saw it dip and that recession follow. Currently where we're at, you see it's way below. So that's where we are currently at on it. You see that it's very inverted. And so that means, we're on the cusp of recession, or, there is a recession coming based off of the data looking at when those yield curves get inverted and how the recession typically follows, looking at historical data.
I mean, technically, we are in recession. We've had negative quarters, right? But there has to be a year reporting on that. So if you look back at the first one right there, you can see the dip is also within the recession there in the 80s, right? We're likely in the same scenario right now. If you look at the 10-year right now, or when I looked at it last night, it was at 3.4. If you minus the 3-month, which is at 4.5, you're negative 1.1. So we're pretty low if we're looking at that number right there. But yeah, so again, recession sounds scarier, but it just means people are going to be more careful, which is not a bad thing, especially if you want stability, for future. So let's see here. So enough about recession stuff, right? That seems gloomy. Let's
We'll get back to it.
Yeah.
We'll get back to it.
Let's talk about housing demand. So basically, we're going to talk about household formations. What we're seeing here is over the last little bit, we were creating new household formations at about 1.75 million a year. What a new household formation is basically, your kids age out, they need to go live somewhere else, they get married, they want to buy a house, that's a formation. They get divorced, you need 2 houses, that's, yeah. So those events, those are household formations, right? So what we're seeing right now is it's dropped by almost 500,000 per year, down to 1.3 is where we're currently at. Now, with that, the reality is those things haven't stopped happening. People still got married, people still getting divorced, all that stuff, kids still aged out, but they're kind of opting to wait for more favorable terms before making a purchase or, one of these household formations official. So you basically have this pent up supply of people that are just waiting. So though it looks lower, there is a lot of people still waiting to go ahead and make these purchases. And that's going to continue on. So that will probably just continue to compound, and they'll sit there dormant till, things are more favorable.
Which is why you hear so many people say, marry the house and date the rate. Get married,
Right.
watch the rate.
Yeah.
Right.
And adjust it, after you're married.
Yeah.
You buy the house.
So that segues right into this, right? So when we're talking about new housing supply,
This is also the national,
mhm,
all of this is national average with this data.
mhm.
I didn't mean to do this.
Oh, you're good. I was saying when it comes to the correlation between this and the previous slide, when it comes to new housing supplies, builders are completing about 1.5 million new units a year. About 100,000 of those, 100,000 units in general need to be replaced. So you have a net of 1.4 million new units basically per year. Currently, with where we're at 1.3, you have an excess, of 100,000 units. So right now, obviously, that's why you're seeing houses sit on the market for longer. Having to get creative, concessions, all that stuff is because there is, 100,000 units extra. But like I said, doesn't mean that there aren't buyers. They're just waiting for more favorable terms because those formations are still happening every single day. They're just not executing on that.
Also, due data is showing that builders are cautious to start new builds right now because they experienced what happened in 2006 and 2009. And so they're not wanting to just rush into something and lose money on their investment. So with it, you see, the housing starts completed, how much are being replaced annually. You do see that, I think we're all feeling it, right? But there is that lack of demand. And this chart is a perfect explanation of why. It's because we have, about 100,000 more total new supply. We have about 1.3 million borrowers. And so because we have more supply than borrowers, and this lack of demand things have started to sit. We have seen prices start to come down a little bit, or more seller concessions, or
You see a lot of builders,
yeah,
pretty substantial.
Yeah.
it's true.
Now they're willing to pay 3%.
But you're looking
I-
at 100,000 units across all 50 states.
Yeah.
Across all 50
Yep.
states.
That was my question. Do you have
It's
like,
not very
numbers?
many.
That's
I don't
like
have Utah numbers.
2,000
Yeah.
units a
No.
state, which is not
A ton.
a lot.
Mm-hmm.
Yeah, they're not way overbuilt.
Mm-hmm.
No. So this is basically showing you have, that stalled demand. But once those people come back in, it's not like we're having all these people start new projects. We may, be in that issue that we're going to have more demand than we're going to have supply very easily, especially here in Utah.
Mm-hmm.
And a lot of builders don't want to drop their price. They'll throw money towards a 2-1 bath buy down,
Right.
or do some extra work on the house, but they like to keep that appraisal where it's been.
Right.
So if things pick up, they can use those. Appraisals.
Yeah, it doesn't impact
Right.
the other units. Yeah.
So it doesn't affect them later on.
Yeah.
Right.
So yeah, no, I saw that exact situation. My brothers, right? They're like, oh, we won't give you a price reduction, but we'll give you 3% concessions, right, with this purchase. They didn't want it to impact the future sales of the other ones.
That's now,
Mm-hmm.
come down and get slower, things change.
Yeah. Well, I mean, in that situation, that was a year ago, January last year. So even back then, we were already starting to see that stuff. So. But yeah, I mean, we've all heard, and we'll continue to hear people say, we're in a housing crash. That's just simply not the case.
Who's heard that? Who's had a client like, I'm worried I'm going to buy because I think
Or
the
I'm waiting
market's
for the
gonna
crash.
Yeah.
And local news has said that too, I've seen some headlines. that
Right.
They're just way off base.
Yeah. I think that's like kind of that fear, right? The fear makes the news.
As Jeff said, I mean, 100,000 units divided by 50 states, that's only 2,000 additional units. That's not that much inventory, overly inventory, especially if you have dormant buyers. But yeah, like I said, it's simply not the case, right? Housing is up 115% over the last 10 years. Over the last 2 years, it's up 39%. And even to close out last year, we were only down 2.5% nationally. So, like I said, there's still appreciation happening, but just not how it was the last 2 years, right? Instead of, house appreciating at 23% rate, you're probably appreciating at a much less rate, but it is still going upwards, and that'll continue to be the case.
I think the moderation does show it is coming down a little bit, right? But it's not skyrocketing down from where we've seen it these last 10 years. When you look at purchasing a home as a long-term investment, over those 10 years, you've really seen that appreciation. If you look at it in these, even this last year, we've seen that come down a little bit, but it's not really, when you look at 2.5 comparatively to 10 years, purchasing a home is a great long-term investment. It may not be a short, get quick, easy money, get rich scheme, but over the long term, you have seen homes appreciate, and currently they're just coming down slightly because of that lack of formation and that lack of demand.
It would be interesting to see target markets like, first-time home buyers versus
Right.
Someone who's trading up to those that are,
Right.
releasing and going to a downside, and how that, I imagine first-time home buyers are being affected a lot, but
Right.
those moving up are less affected because they have equity that they're moving,
Right.
and probably greater incomes.
Right. And with people that are, moving, if they're selling, it's kind of like, all right, we're going to sell for a little lower, but we're going to buy for a little lower. So it kind of, we're kind of getting, around the same thing. Whereas those new first-time home buyers, there are a lot more programs this year that Fannie and Freddie have done to incentivize to get those first-time home buyers better interest rates, which is cool to see. But I do think, and I think even, when the market was crazy and they were offering 50K over, those first-time home buyers, again, they were the ones that were getting hurt.
Yeah, they
the
couldn't.
most.
They couldn't compete. And it's interesting too. It's like a very interesting how each group is different. I mean, for the most part, right now, as far as like my borrowers go, they are all both. If it's a couple, they're both working. That wasn't the case with the older generation. So even though it's more expensive, if they can get creative, they can actually afford it just fine.
We're starting to see a little bit more creative financing, which as you educate people, you can end up buying some properties with no money down type of things, and having encourage people to carry the mortgage and stuff because of the fact that they've got the equity in the house.
Yeah.
If they understand it, and they're an investor savvy type of people.
Well, and then like a quick example, like with my sister, when they went to buy, my brother-in-law was like very hesitant. They make a really good living. My sister's a doctor and he's a software developer. And he was like, what, my payment's gonna be $3,100? He's like, my friends are $2,200. I was like, you guys are way over 300K on income. They are at 50,000. You're making a way way smarter financial decision with your money versus what they are. So you can't look at the number, that someone else is paying and that. You got to look at the full situation. And he's like, oh, you're right. You know what? So just getting him comfortable with his own situation and really understanding that changed the mindset completely. We went under contract a week later on property. Before that, he was really hesitant. Like I said, it's just sitting down and understanding the situation. Like I said, in that situation, he was willing to just wait, and they are now in a home that they love. So
I think it's also, we all tend to think the grass is always greener on the other side, right? And so I think,
It's all the fertilizer you're putting
right. So like I've had clients that are like, oh, I just wish I would have purchased when rates were low. And rates were lower, you did have a lower monthly payment, but it wasn't a perfect market. You still were offering way above the asking price. You're potentially waiving your appraisal deadline. You're waiving your due diligence deadline. You had way more risk as a buyer. And so even though those payments were lower and those rates were lower, it's not that was like the only good time to ever buy. We typically are only looking at the highlights, and we're not looking at, well, what were some of the hard things of that market? With this market, some of my first-time home buyers have really taken advantage, because where they didn't have as much money, the sellers are financing a buy down and closing costs. So they're not having to come in with it, as much. But I do think that it's kind of weighing, all right, what are the pros and the cons of this market? And just explaining that there's not an ideal market that you're going to enter into and have everything just line up perfectly and have it like the butterflies come out and the stars align. And you're like,
marriage.
yeah, there's going to be pros and cons to each market, and you have to weigh those and figure out what your comfort level is with those pros and cons and decide accordingly.
Yeah, my last 5 deals have had 3% concessions on them. So made a huge difference. They didn't have to bring closing costs, and they bought down the rate, So, they were way more comfortable with how it was. But yeah, let's talk real quick a little bit about...
We're almost done.
Yeah, there's only a couple more slides. We'll talk about affordability.
So one of the things in the media that I feel like we've seen that has also increased that fear is like, homes are not affordable. The affordability has gone up this much as a percentage. People are not going to be able to afford their homes. And I think we've constantly heard that. But there's another side to affordability that's often overlooked. It's a really important factor when you're looking at the affordability of homes for your clients.
And just stopping real quick here, I think one big mistake is people look at buying power and call that affordability, when that's not really the scenario. So Sarah will dive into what we mean here by affordability versus buying power,
So let's say in 2021, someone got a $400,000 loan. The rate was at 3.5%. Their monthly payment would be $1,796. That sounds really nice right now, right? Now, let's say, in 2022, we've seen that 10% appreciation. So let's say the loan amount is now $440,000.
For the same or similar home. Right.
For the same or similar home because of that appreciation. So
We're not seeing 10%, we're seeing 20%.
Right.
So we're being conservative.
This is more conservative. So with that, then, I don't know how to work this.
There.
With that, then, let's say the rate's at 6.25%. The monthly principal and interest payment would then be $2,709. So that's up $913 in a year. When you look at it with just this lens, yes, the affordability has gone up. The home seems very unaffordable, correct? Yes. When you look at it, when you start to dive into household income, so with household income, The average person that bought that $400,000 home made $9,000. That's not who would qualify for it. That's the average income of the person that got that $400,000
Or the household,
loan.
so 2 people making $4,500 a month.
Right? So with that, the ADP, and I forget how many they look at.
Millions. ADP processes
I think it's like
everybody's
25
payroll,
million
pretty much.
payrolls. They looked at on average of those payrolls that they processed, people that stayed at their job averaged an income increase of 7.6%. People that switched companies, they averaged an income increase of 15.1%. So if we take those averages together, that's an average income increase of about 9%. Okay, so this is just looking at who bought the home. That $9,000 income with a 9% increase, that would be an increase of about $810. So now they're not making $9,000 for that, $2,709 payment. They're making $9,810 for that. So it's helping to offset it a little bit.
So you see, there you see like the difference is really only $100 compared to its actual affordability, what they're making, versus just looking at the number, which, blinds a lot of people.
But why we've seen that demand is because that's not the only thing that's increased, right? You have increased gas, clothing, food, all these other factors have increased. So if you take into account some of those other factors, the increase is about 1,154 with their 810 increase from their salary. And you see that's kind of why people are feeling it tight. Revolving credit is going up, savings are coming down. Does that make sense?
Mm-hmm.
So let's say for this next year, for 2023, instead of a 9% increase, let's be more conservative. Let's say there's a 5% increase
in income,
in their income. So if they saw a 5% increase this year, that would bring their income this upcoming year to about $10,300. When you look at it with this, you see that, so the income is up about $1,300, but the total expenses with everything is only up about 807. So you see that is really going to help make those other things. And this is if the things stay where they're at, right? We think inflation is going to come down. We think those numbers are going to start to come down, so it's going to feel less tight. But if it were to stay where it were, you see that people are going to feel a little bit more comfortable with their savings and with these other factors because their income is continuing to go up.
If we have a recession.
If we have a recession,
And people are getting laid off, and
right,
companies are cutting back.
which we're seeing
Right.
right now.
Yeah.
Right?
So
I think if we have a recession, and that's where we're looking at it even more conservatively, right? We're not looking at last year's figures when they were up. But typically, if you're staying at your company, you're still seeing at least a little bit of an increase year over year.
You need to see fives this year?
With interest rates,
Mm-hmm.
that's kind of where we're getting to. Yes. So I think that
We're at 6.25 right now.
we're at 6.25 right now.
Higher.
Yeah. And
We're at
this
6
is with
3/4.
Yeah, and so this with a 5% interest rate. So essentially what we think is on the horizon, right? There's no guarantees, but looking at this data, looking at the 10-year treasury yield, looking at inflation numbers, at the CPI, we are thinking that we're going to start seeing rates to come down and even coming down a little quicker because of that lag in shelter costs. That's going to catch up and show where shelter costs actually are, or the servicing value getting added back into the mortgage. So as we see those rates come down, that also softens, the difference if someone's having, a conservative pay increase. Obviously, with the recession, there are layoffs, unfortunately. So that's not going to be the case for everyone. But if you see, a more conservative 5% increase and you see those rates come down, it's going to help start putting that demand back into the market.
Yeah, so when you weigh up the 2021 and 2023 with all those factors, the affordability is about the same. They're both about like 20% debt to income. It's actually like 19. That's really how you got to understand stuff. Like I said, with my sister and my brother-in-law, it's just understanding really their affordability. They were like 12% debt to income. All their friends were like 38, right? Want their $2,200 payment. That's two completely different scenarios, right? Every scenario is different. And
I think it depends on their comfort level.
yeah,
For some of my clients, they feel comfortable with that, and some of them they don't. And so some of it's just giving them the information and letting them figure out what they are comfortable with and putting the ball in their court.
Yeah, and I mean, like, let me just show you. You'll likely see more of this, and this is just will be really quick here. But the common way you'll hear people talk about all this stuff is, hey, in 2021, a $400,000 purchase with 5% down at 3.5% rate, had the same payment, as in 2022, a $292,000 purchase with 5% down at a 6.25% rate, right? So they're like, oh, hey, dummy, you lost 108,000 in purchasing power, good luck buying again. That's super discouraging to hear it that way, right? And that's not the reality. So if you look at it, it's really closer to something like this, right? In today's market, let's see, not today's market. In 2021, that winning offer at 400,000 was probably on a home that was listed for 350, right? They went 50 over asking. If you didn't get it to appraise to that, you'd have to have the 50 extra out of pocket. So if you're a first-time buyer, you're likely already priced out. In 2022, might have sold for a little bit less, but in 2023, you're able to get more creative in that same scenario, right? You could have that $350,000 listing. You could, get it for 325, maybe 335 with 3% in concessions. If that's the case, use 2% to your buy down and 1% towards closing costs, and that drastically changes the scenario. I mean, prior to that, you're at $2,100. Yeah. Well, you can do a permanent buy down with this. So the scenario that I'm showing here is with a permanent 30-year buy down, right? So in this scenario, you buy down from 6.75, which is what I priced out last night, the scenario, down to 5.5 almost on that end, and it brings your payment only $100 more. So if you can afford a higher payment for a little bit, I'd argue that this is the best time to buy because you get a home on discount. And then you just watch rates. When it makes sense, you can refinance, drop that rate. You're in a much better position as opposed to paying $100,000 more for the same house. Which, yeah.
What do you think is better though? Because as interest rates are going to drop, is it still worth doing the buy down rate, or is it better just to get the house cheaper and just change your mortgage when the rates drop instead of putting the money towards buying down the rate? You could get the house for less and just finance and then.
How are your skills in Vegas? I mean, that's what it comes down to, right?
Yeah.
You can permanently buy down a loan and that's what you're going to get for sure. What we're talking
There's no
is
security if you want
we might be at 5.5 this year. We might be at 5 the year following. We might be at 4 somewhere later, right? We don't know.
We don't have a crystal ball.
Another crazy recession comes and rates are through the roof. Then what?
And
there's no guarantee how that's gonna handle
Right.
things, because this is my personal opinion, and here's my rant, is get out of the market,
Let it do its thing.
Yeah.
And go up and down in a normal cycle, we can handle that.
Yeah.
But all this artificial limping and propping up, it just causes a bigger down when we go down.
I expect them to all get reelected if they don't do that.
Oh gosh, don't even start there.
Come on. You gotta do that to get reelected.
And we know that in 2024, rates will drop just for the election.
We're gonna get Trump back in, he's
Yeah.
gonna fix this whole thing, because he's a real estate.
Anyways, to your point, I mean, it just depends. It's a situation, by case. If you, in this scenario, right, if you were instead to get the home for $325 and no concessions, $10,000 amortized over 30 years is like $20 a month difference. It doesn't really make a difference, right?
Yeah, but having
Where-
these tools to know as realtors, all we really are, we put the puzzle pieces together to where it makes it work for the people that need to
Exactly.
connect.
Mhm.
The sellers are unique, the buyers are unique. Our job is to put the pieces together so that that deal works.
Mhm.
And our job really is just to get it in front of the loan officer that can make it look good.
Well, there's a little bit more than that, right?
Well, and I want to answer your question, but I just want to get, because adding to that. So I think the biggest thing, our job is educating the client, right? Because I don't want to gamble for them I don't gamble. I don't want to gamble for my clients. So essentially my goal is, all right, 2-to-1 buy down benefit. If you see rates get lower and you refinance, you get a check to get back what that 2-to-1 buy down was of what you didn't use. That's a big benefit, right? So then not all that money is just wasted. No, you're basically paying up front what that payment would have been over those 2 years. If you've refinanced before that point, then you essentially get a check, you get some money back, right? Con, if it doesn't get better, then you have a rate that's much higher than what you felt comfortable with during those 2 years, right?
So there's no
So
way
you have to
choose
assess.
not to do the buy down, you'd always do the buy down.
Well, you have to assess that risk. I have some that are like 2-to-1 buy down all the way. I want to take the risk. I think rates are going to get lower. I have some that say, I want the permanent buy down so that I'm not stressed over 2 years, worrying about when rates are going to drop. Permanent buy down, once you spend the money on the rate, it's gone. If you refinance, you're not going to get anything back. It's just going to keep it there for 30 years. Whereas if you're using it to lower that purchase price, that's typically, as an investment, very good, but you're not going to see as big of an impact on the payment. So if you're okay with the payment and the payment being higher and not having a buy down, I have a client right now, that's what they want to do. They don't care about what the rate is and what the payment is. They would rather get the home for less. But regardless, it's giving them those options and then they are choosing. Because for me, I don't want clients coming back saying, now you said that this is going to get lower and it didn't. We don't know. We want to look at data and we want to arm people with data, just like we're trying to arm you guys. We want to show you guys what we've seen, potentially what we're going to see because of where our economy and where interest rates are at right now. We cannot predict the future. Even the people at MBS Highway, they make so much money off of mortgage loan officers and predicting the future. They thought rates were going to be 5% by the end of 2022. It wasn't that. So I think that the biggest thing is none of us have a crystal ball. As much as I wish I could tell you this is exactly where it's going to be, we don't know for sure exactly where it's going to be. But based on this data and what the economies usually do over historical, over a certain amount of time, this is kind of where it's leading into. It's leading into we're going to need to see rates get lower because we're going to need to help with, what we've been seeing in the economy. We're headed into recession. The Fed's going to need to, provide some support so that people aren't just up against that wall with their savings and with credit card debt, right? We're expecting inflation to come down and rates typically follow. And so with that, with rates coming down, that also is expected to increase demand. Because if we see, people that their income, let's say it's not appreciating as much, but it is still somewhat appreciating, and you see those rates come down, that payment doesn't feel as heavy, right? Yes, and then I did see your hand, and I do want to, and so I'm sorry, I went on like a rant, but yes.
Well, I think like Randy said, if real estate is a gamble, it always has been and it always will be.
Yeah.
And if you don't have the ability or want to gamble, it's the wrong thing to do because, like they say, we have no one knows for sure what's going to happen, or and history proves that.
Right.
Over and over and over again.
Right. Exactly.
I think what history proves is that owning real estate over time is one of the best things you can actually do. The best thing we can do for our clients is to get them in a home.
Yeah.
So they're not renting anymore. The sooner the better. And we can't judge, they might get laid off in 18 months and lose the home altogether. That's not our fault if that happens. The best thing we can do is convince them that owning is much better than renting.
Right.
And figure out how to get them in a house, not wait for perfect timing. So nobody knows what rates are going to do next. Get them in the home, they can start building equity. Now, if they're planning to leave in a year, don't put them in a home unless they want to turn it into a rental. That's still a good idea. But if they can't afford that, and then buy a new place. If they're only going to be here a year, maybe they should rent. But if they're going to be here 5 to 10 years or longer in their foreseeable future, they need to own a home as soon as possible.
Right. Right. And I even think that is like as a parent, right? Because you're like, this is the market now. What's it going to be for my kids? Like how how do we make sure that people get into homes quicker? Because as a long-term investment, it is one of the best investments that you can make. And you have to live somewhere, so you might as well own it and not make your landlord rich.
Well, talking about the gamble, renting is, I think, a much bigger gamble than owning. Because
Right.
at least you know what you have and you know where you're going with it. But you
Right.
have nothing if you're renting.
I mean,
And
you
at a
can see
certain
even
point,
the,
let's say 30 years pass and the mortgage is paid off, right? Whereas my husband, he's in commercial construction, and he's like, one of our subs is 70 years old. He's still working. He has all these people living in his home because he's an illegal immigrant, and he's still renting. And like, can you imagine how hard that would be? At like that age, you want to retire, but you're still renting because you don't own it yet. Like, I think over time, looking at, and we share the same thing, is that our goal is to help people with long-term investment with that home purchase, and ultimately be able to build wealth throughout their life and have that home purchase be a really big start to doing that.
yeah, like I said, if you look at it, historically it does continue to go up. Just, take some slowdowns at points. That's one of the places we're at right now, is one of those slowdowns. But yeah, that's
Okay, so now we'll get to our conclusion.
It's just
we
two
won't
more
take any
slides.
more of your time. Do you want to do the housing and I'll do?
Sure.
Okay.
So, let me see here. So basically, based off this conclusion, they see low single digit appreciation for most of the US, with pickup in activity, and then that would be led from inflation lowering, which we talked about, from recession-like slowdown, which we talked about, incomes increasing to help affordability, tight inventory, which helps with demand, and rents still expensive and rising. So that's what we're seeing there on the housing forecast.
I didn't get on the MBS highway where he said it's still expensive and rising, because we're seeing them come down.
Yeah,
So when he had that on there, it's like, well, but I do think rent
they're
is
coming
still
down, but they're still higher than they were year over year.
So mortgage rate forecasts. So global quantitative tightening, people are wanting to spend less money, right? A lack of foreign central bank buying, and then more debt to be financed. You guys saw the debt that people have, more people are going to want to finance that debt. Right, right, right.
So that's taxes.
In terms of the mortgages also, we think we're going to see lower inflation, which is going to help lower interest rates. We think there's going to be excess retail inventory. We think there's also going to be an increase in mortgage servicing value, which is going to help rates come down quicker. We also think there is a recession likely based off of the different indicators we see. We think that there is a recession that's on the horizon. It's important to note rates decline during recessions. So for your buyers, and what we've been telling them, why we've been telling them marry the home and date the rate, because rates are not going to stay this high forever. So get the home that you love. And then, in a recession period, historically, we do see those rates come down.
Dad up there's going to be less real estate agents and whatnot.
There already is.
We already said, yeah, you see that already. The last one here.
We've been done for 30 years.
Yeah. So with this, and I take and these are his predictions, so I take them with a little bit of a grain of salt, because he told me 5% into 2022. But he thinks 30-year fixed mortgage rates are going to move to near 5% during the first half of 2023. So he thinks that we will see those rates come lower at the first half of this year. He also thinks that the US 10-year is going to be near 3% or lower, that we'll see both of those come down.
So do you still expect the spread to be 300 bips, or do you think that's going to shrink?
We think it's going to shrink.
It's already shrunk.
If at 3, then we could be below 5.
We could. Yep.
That's right.
Yeah.
It could be 4.75.
If it goes down to that 1.75.
Right, and that's we're already seeing some of that servicing value get added back in when we saw rates to get a little bit lower. As that inflation comes down and rates get even lower, more servicing value is going to be added back in, and you won't see as big of a spread.
I think the rest of the year then, I think it's really just.
We'll see.
Rest for like interest rates, or what do you mean?
Yeah.
Yeah, I think that for interest rates, I think that we're going to start seeing inflation numbers come down, which the biggest reason why the Fed started their rate hikes in the beginning was because they were worried about inflation. And as we start to see those numbers come down, it puts less pressure on them to have to do those rate hikes. So I think as we see inflation come down and as it follows what historically it follows, as long as the Fed doesn't do quantitative easing or, something to mess up, I'm the same. I like them to stay out of it. Just let it do what it's going to do. It will correct itself.
That's right.
We may have hard times, we have good times, but the market will
They
figure
don't
it
know
out.
what they're doing anyway, just stop.
Yeah, I'm in the same boat. So
Yeah, I mean, people stopped buying bonds because inflation was higher than the money that they were locking up. So why would you lock your money up if you're going to lose more on the inflation, right? So the Fed stepped in to try and buy that to keep stuff lower. If these things happen, right, bonds become more attractive again because you can, gain set returns. When that happens, right, yields come down because you don't have to pay out as much. If yield comes down, as we saw, rates also come down. The spread gets smaller. So.
And yet, in our lifetime, when have we ever seen somebody lose $30 billion in a week?
right.
Lost it, gone, boom,
Yeah.
Yeah.
Some issues we can solve, some we can't today. But
yeah, so anyways, there's good news ahead, right? There are buyers, they're waiting to purchase. Deals are still happening every day. Yeah.
And I think if anything, it also gives you more, hopefully, of an insight as to, maybe the fears or some of the things your clients are facing, that their savings have gone down. They are doing more, and there's a vulnerability with that. And I just see that as, even in that situation, let's still see what we can do to help you, right? It's not always at someone's high that you're trying to help them, but even game planning or helping them figure out, all right, how do we get you to this home? Yes, we will. I know it was a ton of information, it was a ton of data. We tried to decipher it, and hopefully give you guys more information so you can see kind of what we've seen, what we could expect to see. Do you guys have any other questions for us or anything you want to add?
Basically, what you've done today is translate bullcrap into English.
We did, yes, we tried to. Hopefully somewhat well.
Thanks, guys.
Thank you guys.
Sarah did bring some food.
Yeah, they've got food for you, so